Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh, your tutor and your mentor. Today, we are going to continue IFRS 15, revenue from contract with customers. We have covered the first three stages of IFRS 15, the contract, the identification of performance obligations, and the identification of transaction price. So now we are going to look at how we can allocate the transaction price to the various performance obligations. So now, first point we need to know, if there's a single performance obligation, then it means we are not going to allocate the transaction price because the performance obligation is single. So therefore, our total transaction price will be allocated to that particular single performance obligation. Now, if there is more than one performance obligation, for instance, if a company is producing a computer and providing a 1 year maintenance services to its customers, then it means the product, the computer is distinct from the services. Now we are going to look at the standalone selling price in separate, but now if the sales of the computer is distinct from the sales of the services, then it means the performance obligations are distinct. So we are going to account for it as two separate performance obligations. So now, if the computer can be sold separately without providing the services to its customers, then it means the computer is a distinct product from the services. Alternatively, if we can provide the service separately without selling the computer, then it means the services is a distinct product from the computer. So both products are distinct, so their stand-alone selling price should be determined. So in this situation, if there's a transaction price, then it means we need to allocate the transaction price to the various performance obligation, which is the computer and the provision of the 1 year services. Very clear. The total transaction price should be allocated to each performance obligation in proportion to the standalone selling price. So now we can allocate the total transaction price based on the proportion of the standalone selling price. Now, when you're talking about standalone selling price, I mentioned according to IFRS 15, if the product or service are distinct, they are separate performance obligation, it means there should be a standalone selling price. The standalone selling price can be, directly observable, or it cannot be directly observable, but there should be a standalone selling price. So now, what is standalone selling price? It means if we can sell the computer without selling or without providing the services, the price we are going to charge for the computer is what we refer to as the standalone selling price for that particular computer. Very clear. Alternatively, if we can offer the services without selling the computer to our customer, the price we are going to charge for that particular services is a stand-alone selling price for that services. So it is clear that these are observable stand-alone selling price. Now, what about if the price is not observable? What situation might prompt for the stand-alone selling price not to be observable? Now, let's assume if we are providing the services to our customer, but within the business, that particular service that we are going to provide for that customer, we don't have the direct observable stand-alone selling price for it, but we have a similar services that we have been providing to various customers within the operation. Then we are going to use that particular, similar, repetitive um, services price to relate it to the stand-alone selling price for this particular service that we are going to provide to our customer. So this is the concept that we need to know. The best evidence of stand-alone selling price is the observable price of the goods or services when the entity sells that goods or services separately in a similar circumstances and to similar customers. So if you can sell the computer without providing or without offering the services to customer, the price we are going to charge for that particular computer is the observable price. Is the price that we are going to sell to all customers, regardless of your age or your circumstance. So that is the standalone selling price. If a standalone selling price is not directly observable, as I explained, then the entity estimate the standalone selling price. You need to determine the standalone selling price based on the similar services that you have been providing, or the similar computer, that you have been, selling out to customer. Simple concept that you need to know. Now we are going to look at discount, very important aspect. Now, let's assume the price for the computer is $5,000 and the price for the services is $1,000. So the combined, if a customer wants both computer and the services, let's assume you are going to charge that particular customer 5,500 because they are going to buy in combine the bulk purchase. But now let's assume the customer wants only the computer, so we are going to charge the customer 5,000. Or another customer wants only the services, then we are going to charge the $1,000. But if a customer wants both the computer and the services, we are going to charge the 5,500. So the difference between the combined transaction price and the combined standalone selling price is what we refer to as a discount. So we need to know, according to IFRS 15, we need to allocate this discount to the various components of the performance obligation. We need to allocate a portion of the discount of the 500 to the computer and a portion of the discount of 500 to the services. This is the normal practice. But we need to know, we need to note this point down. If a product is being sold separately at a discount without the combined sales, then it means that particular product, we need to allocate the discount to that particular product. A discount will only be allocated to a specific component of the transaction price if that component is regularly sold separately at a discount. So without the combined sales, or with the combined sales, the product has been sold at a discount regardless of the situation. So in this particular situation, we are going to allocate the discount of 500 to the computer, for example, or to the services, for example. Now let's assume the computer is being sold at a discount generally minus the combined sales. So it means the 500 we are going to allocate it to the computer, and we're not going to allocate any discount to the services. So this is the concept that you need to know about the discount. So now let's take a look at example illustration so we can able to understand better. The requirement stated, how should the transaction price be allocated? That's what is our concern between the machine and the technical support. But firstly, we need to identify if there's a separate performance obligation or not. So ESCO sells a machine and 1 year free technical support for $50,000. The machine and the 1 year free technical support combined together, the selling price is $50,000. It usually sells the machine for $60,000 without providing the free technical service. The machine is sold for $60,000, but does not sell technical service for this machine as a standalone selling price. There is no directly observable standalone selling price for this technical service, but other support services offered by ESCO attract a markup of 50%. It is expected that the technical support will cost ESCO 10,000. So what they are saying, as I mentioned earlier, if the standalone selling price is, cannot be directly observable, then we are going to use the similar or the repetitive services that the company has been providing. In this situation, regardless of the technical service, the technical support for this machine as a standalone selling price cannot be determined, but other support services offered, other support services offered. So it means there's a similar services that ESCO has been providing. So we are going to use that cost, we are going to use that selling price to determine the standalone selling price for the technical service relating to this particular question. So now, What we are going to do, we are going to solve the particular question. We are going to allocate the transaction. But firstly, we need to calculate the discount component, which is very simple, right? Um, the combined total combined stand-alone selling price, stand-alone price is equals to okay, let me do it by pieces so we can able to get the concept well. Let's first identify the standalone selling price. So machine stand alone selling price is equals to 60 as given in the question, and the technical support given as a markup. I'm not going to deal with the conversion of markup to margin. No, we are going to keep it simple. I'm expecting everyone to know how to convert from markup to margin, and when to use markup and when to use margin. So now the question given us is giving us markup, so, and also the cost is given. So we're going to apply it. So it means um, the profit, the standalone selling price for the technical service will be 10,000 multiplied by 150%. It equals to 150. I mean, sorry, 15,000. So now the total combined stand alone SP will equals to 75. Now the combined transaction price is equals to 50 given the question. So now the difference is what we refer to as the discount, the difference between the combined stand-alone selling price and the combined transaction price, which is 25. So this is the discount. So now we need to allocate the transaction price. Allocate the transaction price to various performance obligations. To machine, for instance. So we are going to allocate based on the stand-alone selling price, right? We are going to allocate the transaction price based on the proportion of the stand-alone selling price. For instance, for the machine, the stand-alone selling price is 60,000. So therefore, it will be 60,000 divided by the stand-alone total combined price, which is 75,000, multiply by the combined transaction price of 50. So this will give us the portion. Where's my calculator? This will give us the portion of the transaction price that only relates to the machine. 60 divided by 75 is 80, 0.8 multiplied by 50. So will equals to 40,000. Then the technical service, the technical support, so technical support will equals to the 15 divided by the 75 multiply by the 50. which will give us 10,000. So now the price of the combined transaction price of 50,000, has been allocated to both performance obligation, the machine and the technical service. So now we are going to recognize revenue for the machine at 40 in our financial statement and the technical support of 10,000. So now the discount of 25,000 has been given. Also, we have alternative approach that we are going to use, which is the discount approach to allocate the transaction price, which is very simple. So now we are going to calculate. This is method one, for example. Um, method one, method one, um, allocate, allocate based on the proportion of stand alone SP. Method two, we are going to use percentage. We are going to use the discount percentage, the discounted percentage. So now you need to calculate the percentage, the discounted percentage. So discounted percentage will equals to the discount of 25, discount of 25, the discount of 25 divided by 75, the selling price, multiplied by 100. So 25 divided by 75 multiplied by 100 will give us 33.33%, equals to 33.33%. So now this percentage, we are going to apply it to the various combined performance obligation. So this is the method two that we are going to use to to allocate the transaction price. So nothing to worry about. 33.33%, you are going to let it from the various transaction price. Then we can get the same answer of 40 and 10. So now we are going to look at stage 5, the revenue recognition, which is very important, and this is the key according to IFRS 15. We need to know at what particular point in time that we are going to recognize revenue. Whether we are going to recognize revenue at a particular point in time, or whether we are going to recognize revenue over a period of time. Now, practically, I can remember I was working at the manufacturing industry. We recognize revenue at a specific point in time when customer decided to purchase the product that we are producing. We have a bridge. So when the customer placed order, then automatically when the customer comes to collect the product, the vehicle use the bridge. We weigh the vehicle when entering. Also, when the vehicle is fully loaded, we weigh the vehicle when it is going out. So automatically, according to the process, we are going to recognize revenue when the vehicle, has been weighed over when going out from the weigh bridge. So at that particular point in time, we are going to recognize the revenue as soon as the vehicle, the vehicle, has gone through the weigh bridge with the product. Then all the liability has been 100% transferred to that particular customer. So every business organization, every entity has its own point in which revenue should be recognized. So this is the reason why IFRS 15 is established clearly, that we need to identify at what point in time what and what should be considered for us to determine the point in time that we are going to recognize our revenue. It should not be vague, it should be consistent, and it should be uniform. So now, Revenue is recognized when or as the entity satisfies the performance obligation. First condition, we are only going to recognize a revenue when the performance obligation has been satisfied by transferring the promised goods or services to its customers. For example, a performance obligation identifier an entity must determine in contract inception whether it satisfies the performance obligation over time or at a specific point in time. Now, let's assume we satisfy the performance obligation at a point in time. What are we going to look out for? If a performance obligation is satisfied at a point in time, then the entity must determine the point in time at which the customer obtained control of the promised asset. As I mentioned, the customer obtained um, control of the promised asset when the vehicle passed the bridge. So at that point in time, 100% of the control has been transferred to the customer. Anything happening from that particular point is the responsibility of the customer, not the business anymore. Control of the asset refers to the ability to direct the use and the use of or and obtain substantial all of the remaining benefits, inflows or savings or in outflow, whichever, from the assets. Controls include ability to prevent other entities from obtaining benefits from an asset. So now key, we need to look out, we need to understand the indicators as to whether control has been transferred to the customer. First condition, entity has the present right to payment for that asset. So based on the contract aspect, the stage one under IFRS 15, there should be a contract. And according to the contract, the payment term should be clearly stated. The amount we are going to pay, the currency we are going to pay, the date we are going to make the payment. So automatically, we are going to recognize revenue if there is present right to payment for that asset. Automatically, if we have transferred the control, if we have given out the asset, it means, you know, it is a must on the customer to pay for that particular product or service. Customer has legal title to the asset. If it is a computer, then you have collected the computer. It means you have the legal title to that particular asset now. So you need to ensure that the transfer has been, the control has been transferred to the customer. So we are going to recognize revenue. Entity has transferred physical possession of the asset. It's very clear. If it is a tangible asset, then once we have transferred the physical possession, the computer, for example, the mobile phone, then it's an indicator that the control has been transferred to the customer. Customers has a significant risk and reward of ownership of the asset. The final condition is customers accepted the asset. So whenever these conditions are met, we need to recognize, revenue at a specific point in time because the control has been transferred at a specific point in time. Now, second condition, satisfy the performance obligation over time. Now, if the performance obligation is not at a particular point in time, it's over a period of time. For example, I was mentioning about the provision of the sales of the computer as well as the provision of 1 year support service. Now, the support service is over time. So we need to identify how we can recognize revenue over time. Very important. An entity transfer control of goods or services over time and therefore satisfies a performance obligation and recognize revenue over time. Over time. We are not going to recognize revenue at a particular point in time, but we are going to recognize it over a period of time. If one of the following criteria is met, if one of the criteria is met, then we are going to recognize revenue over time. First condition, the customer simultaneously receives and consumes the benefits provided by the entity performing and as the entity performs. So now when we are going to look at construction contracts, the aspects of construction contracts can be for 5, 6, 10 years. So therefore, if the process of constructing the building at the same time the customer is receiving benefit from that building, then automatically it's an indication that we need to recognize revenue over time. The entity performance creates or enhance an asset, for example, work in progress, that the customer controls as the asset is created or enhanced. So if the building is going on, for instance, the building is supposed to take 5 years, on annual basis, If the company, the customer has control over the asset, can direct the utilization of the asset, then we can recognize revenue over time. The final condition, the entity performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. So if the company has the right to pay based on the progress, based on the completion to date, and the building, the structure they are putting on, you know, the customer did not have any alternative use of it, you know, I'm sorry, the performance does not create any, you know, asset with an alternative use, then automatically we are going to recognize revenue over time. So these three conditions, any of the conditions, you know, any of the condition is met, then automatically we are going to recognize revenue over a period of time. When we are talking about over a period of time, we are not going to recognize revenue based on the total amount. We are going to prorate that particular amount, the transaction price. Now, in financial reporting, a common application of this is likely to be building company constructing an asset for a customer, provided that the building company is not able to use the asset and has the right for payment, work completion. Revenue will be recognized over time. So for financial reporting, we need to keep it simple. For when we're going to look at construction contracts, we are going to understand better when and how we are going to recognize, revenue over a period of time. Key, for each performance obligation satisfied over time, an entity shall recognize revenue over the time by measuring the progress towards complete satisfaction of that performance obligation. So we have two approaches that we are going to allocate, that we are going to use to determine, to calculate the revenue, to recognize the revenue. We can use the output method or we can use the input method, whichever way. But now we can keep it simple. When we are going to look at construction contract, we can look at the output method as well as we can look at the input method. So now the revenue will be recognized based on the amount of progress made compared to the total price. Don't worry about it. We are going to look at how we can use the output method and how we can use the input method. But basically, the output method, we are going to use the value of work certified, as completed so far compared to the overall contract price. For the input method, we are going to use the cost incurred to date as a proportion of the total cost. So, but let's keep it simple. Try to understand when the indicators for us to recognize revenue at a point in time, or the indicators for us to recognize revenue over a period of time. That's what you need to focus according to the stage 5 for revenue recognition. So in our next session, for instance, you can go through this particular comprehensive example. I'm not going to solve. When we are going to do the live online session, we're going to solve this comprehensive example from stage 1 to stage 5. But basically, let me give you a preamble of the question. On 1st December 2021, Miller received an order from customer for a computer as well as a 12 months of technical support. 12 months of technical support. Computer and 12 months of technical support. Miller delivers the computer and transfer its legal title to the customer on the same day. So it means this is an indicator that we need to recognize revenue at a point in time because we have transferred the liability. The customer pay $400 on 1st December 20th. So on the same day, the customer make a payment. The computer normally sells for 300 and technical and support for 120. So the standalone selling price is 300 and 120. So total price of 420. But now the product is the computer and the technical support, are sold for 400. So now there's a discount. Firstly, stage 1, there's a contract, which is clear because there's an order received from the customer to Miller. Secondly, the stage 2, we need to identify the performance obligation. There is a distinct product because the standalone selling price for both the computer and the technical services given in the question. Stage 3, we need to identify the transaction price, which is 400. Very simple. Stage 4, we need to allocate the transaction price. It's simple to allocate the transaction price. We are going to use for the computer 300 divided by 420 total, and combined transaction price multiplied by 400, which is the transaction price for the combined product. So we are going to calculate it, as well as the final stage we are going to recognize revenue over time. I mean, we are going to recognize revenue at a particular point in time for the computer, and for the technical service, we are going to recognize over time. So this is how we are going to prorate, because we are not going to the technical service is for 12 months. It's not on, we are going to provide the service for 12 months. Once the 12 months is completed, that's the time we are going to entitle to the the revenue for the technical support. So this is the concept that you need to know. In our next lecture, we are going to look at contract cost separately. So thank you very much, guys, for your time.